Hello everyone, my name is Shinta Amalina and now I'm going to present the sixth chapter, Interest Rate and Bond Valuation. The section goal is student will understand how to value bonds and stock, while the module goal, student will understand yield maturity, its calculation and interest. The first that we should understand is about the interest rate and required return. Both interest rate and required return indicates the cost of money, and it is the amount of money that should be paid by the borrower to the lender. So what is the differences between the interest rate and required return? Interest rate usually charged for debt instruments, while required return charged for the equity instruments. What are the debt instruments? It is such as the bank loans or bonds. From the borrower's point of view, they are paying the cost of borrowing funds, while the required of return, it is like they are investing for a common stock and then they will be the owner of that investment, so they are paying for their ownership. There are three factors that might influence the interest rate. The first one, inflation, risk and liquidity preference. What is the relationship between the inflation and interest rates? When the price of goods and services tend to increase, higher returns is expected by the savers. When inflation is high, that indicates higher interest rate. And what is the relationship with the risk? A higher risk of an investment is expected to higher return. The last but not least, liquidity preference, like most of the investor prefer for the short-term securities because it has lower interest rate compared to the long-term securities, and it is more liquid for the short-term securities. So there are two types of interest rate. The first one is the real rate of interest and the second one is the nominal rate of interest. Real rate of interest is they exclude the inflation, risk and liquidity preferences, so they can understand, they can calculate the real amount of cost of borrowers, and the real yield for the lender or investor could be calculated as well. So it is the only cost of fund. While nominal rate of interest, it is the actual rate of interest charged by the supplier of funds and paid by the demander. Term structure of interest rate is the relationship between bond yields and maturities with similar level of risk. And how to understand the term structure of interest, we can understand through the graph. The graph is called as yield curve, and yield maturity is the annual rate of return that have been compounded for the investor's earning of the bond. Now there are three types of yield curve. The first one, inverted yield curve, normal and flat yield curve. So what are the differences between these three yield curves? Inverted yield curve refer to the downward sloping. It is when the interest rate of long-term debt has lower yield than the short-term debt. Uh, Conversely, normal yield curve refers to upward sloping. It is when the interest rate of short-term debt has lower yield than long-term debt, while flat yield curve, it has similar curve between the short-term and long-term. So here, the treasury yield curve, we can understand better for the yield curve. We can see here the three lines, 22nd May 1981 as a downward sloping, and then it is with the blue line, and down here there is 17 May 2014, it is the upward sloping, and at the middle we can have it on September 29, 1989, it is the flat yield curve. So the first one we can see here, the horizontal line, it is the years, while the vertical line, it is the yield maturity. So here we can see less than 5 years, it is the short term, less than 1 year. So here we can see the first line, the very first line, the blue line, it is the downward sloping. So it is the inverted yield curve, while the normal yield curve refer to the yellow line, and the middle one is the flat yield curve. So for corporate bonds, It is a long-term debt instrument that a certain amount of money being borrowed by the corporations and they promise to return the money back in the future under clearly defined terms, and the bonds par value percentage that will be paid annually, and usually it is divided into two times like semi-annually as interest. It is called as coupon interest rate. There are legal aspects of corporate bonds. The first one is the bond indenture. It is a legal document that provides information of bondholders' right and issuing corporate duties. So, and the second, standard debt provisions. The bond issuer must follow the provisions in a bond indenture that specify certain record keeping and practices of general businesses. The restrictive covenants provisions in a bond indenture that place operating and financial constraint on the borrower. So here we can calculate the bond valuation with the principle at first is that, as we studied earlier, bonds are long-term debt instruments that corporate usually pay interest semi-annually, which is 6 months every 6 months, and at a stated coupon interest rate, and it has initial maturity between 10 to 30 years because it is a long-term debt, and it has a par value for $1,000 that must be repaid at maturity. Here we can see the equations to calculate the bond's price equal to cash flow times 1 minus and then we calculate 1 divided to 1 plus interest with power to n divided with the interest, and then par value times 1 divided to 1 plus e power to n. So for example, suppose the firm decides to issue 20-year bonds with a par value of $1,000 and annual coupon payments. The return is expected to be 12%, so the firms offer 12% coupon interest rate. What would be the bond's price? So here we can just input the amount into the equations, but first we should calculate the cash flow. How to calculate the cash flow? 0.12 times 1000, so the cash flow will be $120. After we get the cash flow, we input again to the next part of the equation, so at the end we get the bonds price for $1,000. So the quiz of today's sessions is, suppose the firm decides to issue 20-year bonds with a par value of $1,000 and annual coupon payments. The return is expected to be 10%, so the firm offers 10% coupon interest rate. What would be the bonds price? A. $1,168.64, B. $2,168.64, C. $1,268.64, and D. $2,268.64. So that is the end of our session today. Thank you for your attention and see you.